guy I know makes $93,000 a year, has a steady job, pays his bills on time, and puts a little away each month. By every external measure, he's doing fine. But 2 weeks before payday, he's moving money between accounts just to cover groceries. He's been doing this for 6 years. The amount he earns has gone up. The feeling hasn't changed. That gap between what you earn and what you actually have is not random. It's not bad luck. And it's almost never about the big decisions. It's about a specific set of habits that feel completely normal, that nobody flags as dangerous, that quietly extract money from your life month after month without triggering a single alarm. Here's what makes that hard to see. The habits that keep people financially stuck don't look like mistakes. They look like reasonable choices. They look like what everyone around you is doing. And that's exactly what makes them so effective at keeping the cycle going. So the question worth asking is not whether you're working hard enough. It's whether the system you're operating inside is actually set up to let you get ahead, or whether it's designed to make sure you don't. My name is Alex, and if you've ever done the math on your income and genuinely could not explain where most of it went, consider subscribing before this ends. Because the answer is almost never the obvious one, and I'm going to show you exactly which habits are draining your finances without ever feeling like a mistake, and how the incentives behind each one actually work. Once you understand these patterns, you stop blaming yourself for outcomes that were engineered long before you made the decision. And the first place to look is not your bank app. It's the social traps that are pulling money out of your pocket before you even open your wallet. Here is a number that should not be possible in the wealthiest country on earth. Right now, nearly 63% of Americans are living paycheck to paycheck, not surviving on minimum wage, not recovering from a recent job loss. Working professionals, many of them earning six figures, with nothing left by the end of the month. The income is there. The stability is there. And still, the account drains. That statistic points to something deeper than spending habits. It points to a structural feeling, one that has its own name in Filipino culture. They call it Pesa ng Peligro. Roughly translated, it means the money of danger. It describes those 3 or 4 days right before payday when your funds have run dry, and every small expense feels like a threat. You are not broke in any permanent sense, but in that window, you are one unexpected charge away from a problem. A delayed reimbursement, a parking ticket, a prescription refill. And suddenly you are doing mental math at 11 at night, trying to figure out which payment can wait. The phrase is Filipino, but the feeling is universal. Ask almost anyone in this income bracket, and they will recognize it immediately, not as a distant memory, as last month. So what is actually going on? Because this is not a story about people who never learned to budget. This is a story about people who are doing most things correctly and still ending up in the same place. The question worth sitting with is this: if the problem were simply about spending too much, why does it persist even as income goes up? Here is one piece of the answer. A study released earlier this year found that financial anxiety in the United States is not strongly correlated with income level. It is correlated with the gap between what people expected their financial life to look like by now and what it actually looks like. In other words, it is not about how much you have. It is about the distance between where you thought you would be and where you actually are. That gap is real, and it is growing. The average American household currently carries around $104,000 in debt. When you strip out mortgages and look at consumer debt alone, credit cards, auto loans, personal loans, the number still sits above $23,000 per household. That is not reckless behavior. That is the slow accumulation of small decisions that each seemed reasonable at the time. Take Marcus. He is 34, works in logistics management in Charlotte, and earns around $78,000 a year. He is not a reckless spender. He has a budget. He thinks about money regularly. But when his firm's team lunch became a Friday tradition, he kept showing up. When his cousin's engagement party required a flight and a hotel, he went. When his apartment complex added a premium parking tier, he upgraded. None of those decisions felt like a financial mistake. Each one felt like just participating in normal life. But over 12 months, those frictionless yes decisions quietly added up to nearly $9,000 he could not fully account for. And Marcus is not unusual. He is representative. This is what makes the paycheck-to-paycheck cycle so difficult to break through willpower alone. The individual decisions are invisible. The damage is cumulative. and the math does not reveal itself until you sit down and run it all the way through, which most people never do. Now, you might be thinking, okay, so the data problem is awareness. If people just tracked better, they would fix it. And that sounds right on the surface. But tracking is not the core issue. The core issue is that many of the habits draining money were not chosen consciously. They were absorbed from social environments, from cultural expectations, from systems that were specifically designed to make spending feel natural and saving feel like deprivation. And that is exactly where the social traps come in. The subtle pressures built into your relationships and your surroundings that make certain financial habits feel almost impossible to refuse. There is a psychological experiment that has been replicated dozens of times across different countries and age groups, and the result is always the same. When people are shown images of luxury cars, designer watches, and expensive homes, their willingness to take on debt increases significantly within minutes, not because they suddenly want those things, but exposure to status symbols activates something older and more automatic than rational decision-making. It triggers the part of the brain that is constantly asking one question: how do I look relative to everyone around me? That instinct is ancient. For most of human history, your social standing determined your access to resources, protection, and opportunity. Falling behind the group was genuinely dangerous. So the brain developed a hair trigger response to status, always scanning, always comparing, always calculating where you rank. The problem is that the same mechanism is now running inside a consumer economy, specifically engineered to exploit it. And the results are measurable. Currently, the average monthly payment on a new vehicle in the United States sits at around $735. The average loan term has stretched to nearly 72 months. That is 6 years of payments on an asset that loses roughly 20% of its value the moment it leaves the lot. People are not making that decision because they did the math, and it made sense. They are making it because a certain car communicates something they want to communicate, and the financing system is built to make that signal as affordable feeling as possible while extracting maximum return over time. This is the status trap in its clearest form. You are not buying the car. You are buying what the car says about you. And you are paying for that message for 6 years, with interest. Consider Derek. He is 38, works as a regional sales director in Atlanta, and earns around $91,000 a year. When his company started doing better and a few colleagues upgraded their vehicles, Derek felt it, not as explicit pressure, more like a low hum, a quiet sense that his 4-year-old sedan was starting to say the wrong things about where he was in his career. So he leased a new SUV, $812 a month. He told himself it was a business decision. A professional image matters in sales. And honestly, that is not entirely wrong. But when you run the numbers, $812 a month over 36 months, Derek committed $44,000 to a vehicle he will never own, primarily to manage a perception. That is not a car payment. That is an expensive reputation management contract. And Derek is far from alone. This year, Americans are collectively carrying over $1 trillion in auto loan debt. A significant portion of that is people financing more vehicles than they need because of what the vehicle communicates, not because of what it does. Now, here is the part that rarely gets said out loud. The people you are trying to impress with these signals are mostly not paying attention. They are too busy managing their own signals. The colleague who notices your new car this week will forget it by next month, but you will be making that payment for the next 72 months. The audience for the performance is far less engaged than the cost of the performance suggests. There is a Filipino concept called pakisama, the deep cultural pressure to go along, to say yes, to maintain harmony within the group, even at personal cost. You do not have to be Filipino to feel it. It shows up every time your friends choose a restaurant that is $40 a plate and you say nothing. Every time a group vacation gets planned, opting out feels socially complicated. Every time spending money becomes the price of belonging. That pressure is real. It is not weakness, but left unexamined, it is expensive. The fix is not to stop participating in social life. It is to get clear on which decisions are genuinely yours and which ones you made, because the environment made saying no feel harder than saying yes. Once you have seen the social trap clearly, a harder one comes into focus: the math of poverty. The way the consumer system itself is rigged to make every transaction cost you more than the price tag suggests. Every major e commerce platform in the world employs teams of behavioral scientists whose entire job is to study the moment your willpower weakens. They know exactly how long you will browse before impulse overrides intention. They know which color buttons increase purchase rates. They know that showing you a crossed out original price triggers a loss aversion response so strong that it can override your budget in under 3 seconds. This is not speculation. It is a documented, funded, continuously optimized science. And you're on the receiving end of it every time you open an app. Currently, impulse purchases account for roughly 40% of all e commerce spending in the United States. That number has climbed steadily as recommendation algorithms have gotten sharper, and checkout friction has been reduced to a single tap. The stores are not just selling products anymore, they are selling the feeling of deciding, while quietly doing most of the deciding for you. And when you get to checkout, the system doubles down. Studies consistently show that shoppers who arrived intending to buy one item leave, having purchased additional ones at checkout more than 60% of the time. The upsell is not an accident. It is the architecture. You were always going to see that screen. The question was only whether it would work on you this time. Then comes the offer that feels generous, but rarely is. Buy now, pay later. 4 interest-free installments. No credit check. Instant approval. On the surface, it sounds like a reasonable tool, spreading out a necessary purchase without paying extra. And sometimes it is. But here is how it plays out in practice. The companies offering these plans make their real money on late fees. Miss a single payment, and the penalty can hit 25% of the original purchase price. Buy a $200 item, miss one installment, and you have just paid $50 for the privilege of being late. The interest-free promise holds only if your timing is perfect, and the plan counts on the fact that it often will not be. This is the architecture of the math of poverty, not one catastrophic decision, a series of small transactions, each engineered to extract a little more than the stated price. The credit card version of this is where the math becomes genuinely alarming. The average credit card interest rate in the United States is currently sitting just above 28% annually. If you carry a balance, which roughly half of all cardholders do every month, the cost of everything you bought on that card quietly increases from the moment you fail to pay it in full. Here is a concrete example. Say Renee is a 31-year-old graphic designer in Phoenix. She puts $160 on her card for new software, intending to pay it off next month. Life gets busy. She makes the minimum payment instead. Then the month after. At 28% interest, making only minimum payments, that $160 ends up costing her closer to $340 by the time it is paid off. She paid more than double for software she bought on a Tuesday without thinking twice. Now multiply that across a card balance carrying several $1,000s. The interest alone on a $4,000 balance at current rates costs nearly $95 a month before you have paid down a single dollar of what you owe. Your paycheck arrives. You make a payment. The balance barely moves. That is not a spending problem anymore. That is a math problem. And the math is not on your side. The honest framing is this. The moment you carry consumer debt, not a mortgage, not a calculated investment loan, but debt on things that depreciate or disappear, a portion of every future paycheck is already spent. Your working hours you have not yet lived to pay for things you have already consumed. That is the mechanism, not a moral judgment, just the arithmetic. Seeing it clearly does not fix it overnight, but it changes how you look at every transaction that follows. And the next place to look is the quieter drain, the money leaks you're not even aware you are plugging, hidden inside subscriptions, shortcuts, and the habit of choosing cheap over smart. If someone walked up to you and asked for $30, you would notice. You would think about it. You would probably say no. But if $30 disappeared from your account quietly, in 3 separate $10 increments, spread across different billing dates, attached to services you signed up for months ago and barely remember, you would not notice at all. That is not carelessness. That is how the system is designed to work. Currently, the average American is paying for somewhere between 4 and 7 subscription services at any given time. That number has risen sharply over the past 5 years, as nearly every software product, media platform, and consumer service has shifted to a recurring billing model. The business logic is straightforward. A customer who pays once is worth 1 transaction. A customer on a monthly subscription is worth 12 transactions a year, automatically. with no additional sales effort required. The model is brilliant for the company. For the customer, it requires active management that most people never do. The free trial is the entry point. It is structured specifically to outlast your attention. You sign up, you explore the product for a few days, life moves on, and the trial converts to a paid subscription on a date you no longer remember. A survey released earlier this year found that 54% of Americans are currently paying for at least one subscription they have not used in the past 3 months. That is not a small oversight. Across the average household, unused subscriptions quietly drain between $40 and $80 a month. Over a year, that is close to $700 spent on nothing. The fix here is mechanical, not motivational. Once a quarter, pull up your bank and credit card statements and filter by recurring charges. List every subscription. For each one, ask a single question. Did I use this at least twice last month? If the answer is no, cancel it the same day. Do not put it on a list. Do not tell yourself you will get back into it. Cancel it now. You can always resubscribe if you genuinely miss it. Almost nobody does. But subscriptions are only one category of money leak. There is a subtler one that costs people significantly more over time, and it hides behind a habit that feels responsible. The habit of choosing the cheapest option available. Being cheap and being frugal are not the same thing. Frugality is about maximizing the value you get per dollar spent. Being cheap is about minimizing the number on the price tag, regardless of what that number actually buys you. The distinction sounds minor. The financial outcomes are very different. Here's how this played out for someone I know. James is a 42-year-old contractor in Denver. Last winter, his truck started showing an engine warning. A certified mechanic quoted him $1,800 for a proper diagnosis and fix. A guy down the street offered to patch it for $350. James took the cheaper option. 6 weeks later, the warning light came back. The patch had addressed a symptom, not the source. He went back to the original mechanic. The repair now costs $2,200 because the underlying issue has progressed. In total, James paid $2,550 for a problem that would have cost him $1,800 if he had just addressed it properly the first time. The cheap option cost him $750 extra and 6 weeks of driving a compromised vehicle. This pattern repeats across dozens of categories. The cheap appliance that fails in 18 months, when the quality version would have lasted a decade. The discount service that creates a problem requiring a professional to undo. The fast fashion purchase is made 4 times instead of one durable item bought once. Every time, the logic feels sound in the moment. Every time, the math tells a different story over a longer timeline. A useful reframe is this. Before choosing the cheaper option, ask what the total cost of ownership looks like over 2 or 3 years, not just today. That single question catches most of the bad decisions before they happen. Plugging these leaks stops the bleeding. But stopping the bleeding is not the same as building something. And that is exactly what the wealth blueprint is about. Not just protecting what you have, but building a system that grows it. Most people manage their money in a specific order. Income arrives, bills get paid, life gets lived. And whatever is left at the end of the month goes towards savings. It sounds logical. It feels responsible. The problem is that in practice, there is almost never anything left. Not because the income is too low, because the system is designed to expand to fill whatever space is available. Expenses do not wait for savings. They arrive first. They grow to meet the budget, and savings get squeezed out before they ever had a real chance. The wealth blueprint starts by reversing that sequence entirely. Paying yourself first sounds like a motivational phrase. It is actually a structural intervention. The moment your paycheck hits, a fixed percentage moves automatically into a savings or investment account before a single bill is paid, before a single purchase is made, before your brain has a chance to negotiate with itself about whether this month is a good month to save. The transfer happens first. You build your life around what remains. Currently, financial planners broadly recommend a minimum of 10%. If that feels impossible right now, start with 3%. The amount matters less than the automation. Once the behavior is removed from your decision-making, it becomes invisible. And invisible savings accumulate in a way that conscious ones rarely do. The framework that makes this sustainable is the 50-30-20 rule. 50% of your take-home income covers needs: rent, utilities, groceries, insurance, minimum debt payments. 30% covers wants: dining out, travel, entertainment, the things that make life livable rather than just survivable. 20% goes directly to savings and investments, non negotiable, already moved before the other two categories have a chance to grow into it. The value of this framework is not the specific percentages, it is the permission structure. The 30% for wants means you're not white knuckling your way through a zero spending diet. You are spending deliberately within a boundary without guilt. That combination, structure plus permission, is what makes financial habits actually stick. Once the foundation is in place, the next question is where the 20% goes. And this is where the difference between working for money and having money work for you becomes concrete. A salaried job produces linear returns. You trade 1 hour of your time for 1 hour of wages. Stop working, stop earning. That model has a hard ceiling. There are only so many hours available, and your income is capped by how many of them you can sell. Building toward exponential returns means creating income streams that do not require your active presence to generate a return. Index funds inside a retirement account, a rental property, a digital product, a business that operates without you in every transaction. The specific vehicle matters less than the underlying shift, from exchanging time for money to deploying capital that earns while you are doing something else entirely. The math behind this shift is worth walking through slowly. Say, Christine is 27 years old, works as a marketing manager in Seattle, and starts investing $5,000 a year into a broad market index fund inside her employer-sponsored retirement account. That is a 401k, her workplace retirement savings plan. At a historical average annual return of around 7%, by the time she is 65, that account holds approximately $1,040,000. She contributed a total of $190,000 over those 38 years. The remaining $850,000 was generated entirely by time and compounding. She did not earn it by working harder. She earned it by starting. Now, say Christine waits 10 years and starts at 37 instead. Same contribution, same return rate. By 65, she has around $510,000. The delay cost her $530,000 in growth, nearly 3 times what she actually contributed, simply by waiting a decade to begin. That is not a minor difference in outcome. That is the difference between retiring with options and retiring with constraints. The habits covered in this video, the social traps, the consumer math, the money leaks, the reversed cash flow, all of them matter. But none of them matter as much as the gap between starting today and starting later. Here's what this all points to. The reason so many people with stable incomes still feel financially stuck is not a failure of effort or intelligence. It is a failure of visibility. The habits that drain money are largely invisible. The social pressure to spend feels like participation. The consumer math is deliberately obscured. The leaks are small enough to ignore individually and significant enough to matter collectively. Once you can see the mechanism, the experience stops feeling like a personal shortcoming and starts making sense as a predictable outcome of a system you were never fully shown. A few things worth carrying forward. Status spending always costs more than the price tag. Consumer systems are optimized to extract, not to serve. Small recurring costs compound just like investments do, only in the wrong direction. And time is the one variable in the wealth equation that cannot be recovered once it is spent. Watch your next 3 financial decisions closely, not to judge them, just to notice what is actually driving them. Is it a genuine need, a conscious choice, or is it the environment deciding for you? The habits are visible now. What you do with that visibility is the only question that remains.